Bienvenidos a esta nueva edición de RiskMathics TV. En esta ocasión tenemos el gusto y el honor de contar con la presencia de Brett King, reconocido futurista, experto en Digital Banking, asesor de la administración Obama en materia de tecnología financiera, reconocido autor de bestsellers, dirige un renombrado programa de radio sobre tendencias tecnológicas, conferencista internacional, conferencista en TED, etc. No habría tiempo para discutir todo lo que Brett King ha hecho y está el día de hoy con nosotros para platicar sobre las tendencias de la tecnología financiera y hablar del futuro que viene y cómo ese futuro nos reta el día de hoy a innovar, a ser disruptivos en la industria financiera. Brett, it's such a pleasure to have you here with us.
Gerardo, it's a great privilege to be here, and I thank RiskMathics for inviting me along to this conference. It's been a great couple of days.
Okay, I'm sure you have enjoyed your stay here, and I want to take the advantage to talk to you about this book, Bank for exactly, which follows the steps of Bank 2.0, 3.0. Give us a brief overview. What is this evolution from the 1.0 to the 4.0?
So you can actually sort of track it on a graph. The world's moving from physical to digital distribution, and physical value chains to digitally operated value chains. But in banking, we're also moving from high friction, lots of paperwork, lots of rules, to low friction, low latency engagement. So if you look at mobile payments as an example today, in places like China, mobile payments can be done instantly using a mobile phone. In Kenya, you can send money from one person's phone to another instantly using M-Pesa. In the US, they're still writing checks. This is the old system. So these shifts that are occurring, you can track them. 1.0 is traditional banking. 2.0, sort of the self-service era of banking with internet and ATMs and phone banking. 3.0, the emergence of the smartphone. And then 4.0 is really where we see the technology taking over the way we think about banking. Banking available only primarily through technologies, things like a smartphone or a voice-based smart speaker in your home, or in the future, smart glasses in maybe 5 to 7 years' time.
Actually, that rattles my mind. Glasses. I mean, I have heard about devices and technology, but how do glasses come into play when we talk about banking?
So the next big thing in computing terms is voice-based AI, but then after that, this is a futurist hat on now, right, is spatial computing, what they call spatial computing. And so this is embedding computing in the world around us. But the glasses we wear will actually be able to present screens in the field of view. So this shows you VR up on the screen here. So you'll have these glasses and you'll be able to see a screen. If you want to type on a screen, it'll be projected into your field of view. You won't actually need a physical screen. You'll be able to, as you're walking around the city of Mexico, you'll get information like a GPS giving you directions. You'll get that in your glasses rather than on a smartphone. Because the objective here is, just like fighter pilots in a jet, we're trying to present the information so it distracts you minimally. Because if you have to look down at your phone and you're driving the car, you could have an accident, right? If you have information presented in your field of view, it's better. So spatial computing is the next big thing, sort of halfway through next decade.
Okay, now that you mentioned AI, what role will AI play in the future?
So the artificial intelligence in the initial stages is about robotic process automation. So taking things that we've done in the real world where humans run those processes and automating that to make businesses more efficient and therefore produce more profitability. The second piece is where we have AI built as sort of data synthesis tools, taking lots of data in and starting to give us advice, whether that is advice on our health, being physically healthy and fit, or whether it is advice on how to best spend our money, or legal advice, or whatever it is, advice built into the real world. The next part of that is where we use AI to solve big problems. So big problems of data crunching, or problems that, from computing terms, traditional computers aren't able to produce. So eventually, we'll have AI probably in about 20 years, AI that mimics humans, can pass the Turing test.
Does it mean that because of AI, banks will be able, based on my behavior, to get ahead of my needs?
Absolutely. Predictive is a very core part of this. So the banks of the future that are successful are banks that understand what you need even before you do, right? So, for example, if you're a small business, you're in the retail environment and you're growing, your bank should be able to say to you, you're going to need some capital to grow your business next year at the rate you're currently growing. It should know that based on cash flow. Or, be able to answer a question where you say to your bank, hey Siri, Alexa, can I afford to go out for dinner tonight? Can I afford to buy a new smartphone? When can I afford to buy the family a new car?
Is it wise to buy this jacket?
Exactly. And so you'll be getting advice. And, your AI will give you that contextually as you go about your life. And that's really sort of the future of what we call the smart bank account. A bank account that lives with you, that responds to your needs based on you uniquely as an individual and helps you with problems as they arise.
Wow, actually, all these prompts 2 or 3 questions. First, you talk about the banks of the future. In the latest economic forum in Davos, Switzerland, Oliver Wyman, this consulting firm, distributed this report about the digital banking and how traditional banks are not up to date completely. Are mainstream banks getting it?
Well, I look to the leadership of the bank to see whether they're getting it. Are the banks saying, in the future we have to be a technology company? Are their leaders talking about how they compete with fintechs, how they work with fintechs? All of this type of discussion you only see from a handful of banks around the world today. Maybe a dozen or so, right? And when you look further, I look at the leadership structure. I look at the executive branch of the company, the executive committees. I look at the board members and I say, how many of them have deep technology experience to be able to transform the bank into this future that we're moving to? There's only a handful of them, maybe a dozen in the world. I'm a big fan of Capital One in the US, BBVA, the Spanish bank, of course, which is here, DBS in Singapore. The Chinese banks have done very well because they've been forced to compete with Alipay. So Ping An Bank, incredibly, they went from being the worst performing stock in the start of 2018 in China for banking stocks to the best performing stock this year because of their focus on technology investment in the bank. So, there's a few examples, but I really look for the leadership. Who's leading this technology charge?
How do bankers of the future are going to look like? Are they going to look like the traditional banker, or are they going to look like the cool techie guy?
So let me tell you about some of the jobs that will become central to banking in the future to give you an idea. I always say to the bankers, stop hiring bankers. You don't need any more bankers, right? What you need is new skills. So the biggest jobs that we need to fill over the next 10 years, things like data scientists, AI specialists, machine learning specialists, experienced designers, behavioral psychologists that understand when and where you need the technology of banking in your life, algorithmic risk programmers, identity brokers that understand where to get the right sources of identity data, blockchain integrators. These are the types of roles that are going to define a bank.
I could add economists. I'm an economist, so I'm talking on behalf of my profession.
So, if you think about economists, a lot of the economic work that we're doing in the future will be based on data. And so data scientists and AI will be very commonplace in economics.
Okay. There is a term that has come up, semantic banking. We talked about semantic web for years. What is exactly semantic banking?
So when we talk about semantics, we're really talking about the sort of the language of banking and the way it's integrated into your world. And so when we talk about banking today, most of the time, people understand the banks have an expectation that if you want bank banking access, banking products and services, you have to come to the bank,
Exactly.
right? But the semantics of banking are changing, where those expectations will be that it's embedded in the world around you. And so a good example here in Mexico is CODI, the payments architecture, right? That's going to launch in September, I believe, here. And so that's a good example because, two-thirds of Mexico's population hasn't been included in the formal banking system. Okay. If CODI works as we expect it will, it'll go a long way to solving part of this problem. So you have, millions of Mexicans will come into the financial services system through mobile. The way they talk about banking, their expectations of banking will be very different from someone who's had a bank account for the last 20 or 30 years and has been trained by banks as to how it works. So really what we're talking about is how banking functions in the world around you, the semantics of that, the ubiquitous nature of banking, the fact that it's going to be embedded in the world around you and just be there as a utility rather than stop what you're doing, go to the bank, meet their identity requirements, fill out the forms, and if you're not too risky, we'll give you access to banking, and then you can go back to doing what you're doing. That's the old way of thinking, that banking was so important, so differentiated, that you had to stop buying a house, then you had to enter into the process of buying a mortgage, and then only then, if you qualified, you could go back to buying a house. When banking in the future is going to be, oh, you want to buy a home? Here are the options for you, while you're in the home trying to sign the contract or do the contract for buying the home.
Now that you touch upon this subject of CODI, for example, that will allow even small mom and pop stores to get into the financial sector, into financial payments. Yes. How does digital banking foster financial inclusion, such an important issue in a country like Mexico?
One of the biggest problems that we have is that financial services for those that are excluded in the Mexican system today, it's very expensive if you don't sit in the current banking system when you have to interact. So, for example, if you have to pay a bill and the only way you can pay it is electronically, then you have to use an intermediary to pay with cash and pay this bill. And the intermediary will charge you large fees. In the United States, for those that are financially excluded, which is about 20% of households in the United States, they pay up to a quarter of their income in fees for conversion of cash into the formal banking system. And so it's very expensive for people excluded from the system. Also, they don't get access to credit. If they haven't had a bank account, they can't get access to credit. They can't grow their business easily. And also, they don't save as much money. When people have cash, we saw with M-Pesa in Kenya, that when people relied on cash, when they moved to M-Pesa, the mobile wallet, they saved about a quarter more, about 20-25% more than people who only use cash, because once it was sitting in a wallet, they were less inclined to spend it. And so it made them financially healthier as well. So when you fix the problems of financial inclusion, you also fix a lot of the problems around financial health and well-being and access to credit to help people to mobilize up the economic ladder.
What will happen to cash?
We will see in the 2020s, we will see the first economies in the world go cashless. So economies like the Nordics, Sweden, Finland, Singapore in Asia. China, interestingly, may be one of the first major economies to go cashless as a result of the dominance of mobile payments there as well. So being a cashless economy over the next 10 years is going to become quite fashionable. There's a couple of drivers for this. One is obviously a lot of the services we will access in the future, mobile commerce services, e-commerce services, those based on AI agents where you just talk and book a flight or book a restaurant using your voice, you won't be able to use cash for that. You'll have to be using digital payments mechanisms. And so that's going to be a strong driver. The second driver is that most governments recognize that most crime occurs and most money laundering occurs because of the availability of cash. So if you want to stop criminal activities around cash, the illicit use of cash, and you want to stop money laundering, you have to get rid of physical cash. Now, it doesn't say money laundering is not going to happen with digital, but it'll certainly be at a lower scale than we have with the cash-based economy. So governments, they're incentivized strongly to remove cash from the economy as well.
Well, actually, it brings up the question of security, cybersecurity and biometrics, etc., etc. These that you have mentioned that we still have to go to a branch, and we need some executive to look at us and recognize us against an ID, a passport, or in Mexico we use the national election credential as an ID. What will happen to all that? Can that change? Will digitalization make financial services more secure for the normal people?
So if you look at most companies where they have a strong national ID infrastructure, like in Mexico, we're starting to see that augmented by data. So we're starting to put biometrics in there using a fingerprint, like the Aadhaar card in India is a good example of that, or linking it to medical databases and so forth. Now, there is obviously a question about those databases. Are they secure, the government databases that we have? But ultimately, when we want to identify you in the future, we won't do it with a human looking at your identity card. We'll do it the way you do it when you come into the airport, where you use your fingerprints or you use facial recognition, biometrics, because that's much more secure. It's much more reliable than a human checking your signature or checking your identity card. Because biometrics don't lie. Someone can produce a fake identity card and make us believe they're you, but your fingerprints, your facial patterns, your voice patterns, all of these things are unique to you. And if someone has stolen your physical identity, they can't steal those aspects. So to make the future system secure, we have to incorporate these elements as well as behavioral elements. So we find that your behavior makes you unique in the world. What you do, where you go, where you like to eat, what you like to buy, what TV you like to watch. All of these behavioral elements are like a signature or a fingerprint that enable us to recognize you. So in the future, we will use this data to identify you. And it will be almost impossible for someone to steal your identity because they can't pretend to be you convincingly enough to trick these algorithms. And we'll secure this whole thing with new encryption technologies like quantum computers, polymorphic encryption, and blockchain databases that reinforce themselves. You put all these technologies together and it makes an ecosystem that's much, much more secure than physical signature on a piece of paper. We're talking thousands of times safer and more secure than the identity infrastructure we have today.
As a general user of financial services, banking services, we all have suffered the burden of all these know your customer compliance practices. Will that become easier, more simple?
Yes. I joke about KYC, know your customer. I joke it really stands for kill your customers with paperwork, right? Because the burden of compliance has just been passed on to customers recently. I recently went into a bank in the US, I won't say who they are, to open a business account. I was starting a new business, open a business account, and I couldn't open the account because they needed some certain paper that I didn't have, and it was so frustrating because it was unnecessary, right? So I look at this and I look at what's the problem you're trying to solve? In terms of KYC, the bank has a burden to make sure you are who you say you are. But we can do that much better with data than we can with a signature on an application form. Frankly, the data we would collect on an application form is no longer sufficient for us to adequately identify you. And it's no longer securable because someone can find out that information and pretend to be you. And so ultimately it's a data problem. and we need more data than you can capture on an application form. So KYC is going to be highly automated based on data gathering and data collection. You may have to submit in terms of giving some digital access to your data to qualify for access to banking, for example, but it's all going to be data-driven.
What will happen to branches? Because we have been living with the branch-based model for banking for centuries.
Yes, in fact, at least since the 1400s. Well, the key thing is that in this digital world where banking is real time, the fact is that a branch is a fairly inefficient way to access banking. Also, it's going to be fairly costly compared with digital acquisition strategies that we see, the fintechs, for example, employing. So at some point, bankers will recognize that it may be, if you're in the US, for example, it may be costing you $300 or $1,000 to open an account for a customer in a bank branch because of the cost of the infrastructure, the processing costs, the physical person costs in the branch, and the advertising and marketing costs to get a person to physically come to your bank branch, whereas a digital competitor can do the same for maybe $5 or $10. We're talking about fractional cost. So at some point, bankers will make the assessment themselves that bank branches are just not an efficient way to do banking for 90% of day-to-day banking. And at that point, the branches that remain will be highly specialized based on those 10% of use cases that you can't do well on digital. So bank branches won't disappear, but they won't become the way. You won't certainly open an account in a bank branch. You'll open an account through technology.
Okay, I have to ask this, that given that we're talking about the future of financial services, cryptocurrencies and the underlying technology, blockchain, are they a fashion or are they here to stay?
So ultimately, if you look at blockchain, and you have to think about blockchain and crypto quite separately. Even though crypto sits on top of blockchain, they're two very different disciplines. One's talking about value exchange and money and value systems. The other is a database or data storage mechanism. If you look at the evolution of databases, one of the problems we have with databases today is if you've got databases centralized, it makes transferring information less efficient. And it makes the fact that if you can compromise that database in terms of hacking or security, you get open access to all that data once you break through that layer of security. If you have a blockchain database, it's a distributed database system, and it reinforces its own security because if someone tries to hack the system, the other databases sort of self-correct the database that's been hacked. And availability or access of data is much faster because you've got access to a copy of the database that everyone agrees upon, wherever you might be. So blockchain is a natural evolution in a world where we need to share lots of data all the time. It's fairly predictable we need to go down that way. Some sort of distributed database, or we call it distributed ledger technology. On the other side, you have Bitcoin and other cryptos that emerged, and Bitcoin used blockchain as a better mechanism to secure the auditability and the immutability, as it's called, of the exchange of value of Bitcoin. But Bitcoin was supposed to be this sort of replacement for US dollars, sort of a digital money. But it was badly designed, and so people started hoarding Bitcoin thinking they're going to make $1 million out of their Bitcoin, and so it became like a digital gold or a digital asset, like an investment class. The real way to get cryptocurrencies that everyone uses, replacing money, is to encourage value exchange, not storage. And so that was a design problem in Bitcoin. But some of the newer cryptocurrencies and tokens emerging show ways of creating value exchange and utility you can't easily do with cash. Tokens are a good example. They at the start we thought they looked like stocks or equity in stocks in the stock market. But when you look at something, say like the solar coin that Sun Exchange deploys, it's a crypto token. and it converts, every time you generate a kilowatt of electricity on a solar panel, it creates a token to value that energy that's produced. And so you can now start to create value exchange mechanisms based on utility. Number of hours driven, number of hours flown for a robot drone, and you have different ways of creating value exchange mechanisms as AIs start to do the trading between us. So it's a natural evolution of the commodities markets and the capital markets to try and create value exchange mechanisms in a real-time digital world. So it's a fairly natural evolution. I think they're here to stay.
Well, now that we review all these trends, innovations, challenges for some players in the industry like regulators. What is going to be the role of regulators? How can regulators help foster this process, not inhibit it?
So the role of regulators are quite important. They're gatekeepers for a lot of the time for new technologies. And the problem is, if a regulator doesn't understand a technology like AI, they will immediately assume that it's risky because they don't know what the risks are that are involved. And so they hold back and they say, well, we'll see in the future, but we're not sure about this. And so that's the typical approach regulators have taken with new technologies. We'll wait to see how it evolves, we'll make sure it's absolutely safe for our customers, and then and only then we'll let it happen in the market. But in traditional terms, this could take 7, 10, 20 years maybe. When you have new startups that can change the world in 3 or 4 years because they create this new technology that suddenly everyone starts using, you have a situation where innovation is occurring much faster than regulators can respond. So that changes the approach that regulators must take. They can't be about saying no to new technology. They have to be about saying, how do we do this safely? So they have to start experimenting more. They have to start working with these innovators and allowing them to experiment and be directly involved in the deployment of these new technologies so they can determine where the risks are involved, not sitting back and waiting for these platforms to emerge in the future. So regulators have to become very technology savvy. They have to change the way they incorporate these innovations in the market, sandboxes and new types of licenses and things like that. In the US today, Moven's been trying to acquire a banking license for the last couple of years. The problem is, every time we have FDIC involved, they say, if you acquire this bank, you have to keep the bank branches open. And we're like, we're a mobile app, we don't want bank branches. And they're like, no, the law is. The Community Reinvestment Act of 1977 says financial inclusion in the United States is through bank branches. You must keep the bank branch open. And my answer to that is, the law is woefully out of date. Don't force me to do something that's not practical for us. We should be able to have a digital charter that doesn't require a bank branch. But the US doesn't allow that. Now, this is where other markets have already moved, Singapore has a fintech license. Hong Kong has a fintech license. Australia, China, London all have fintech licenses. The EU all have fintech licenses. So in this respect, the US is well behind. But this shows you the different responses of different regulators. Frankly, the more regulation you have, the more laws and rules you have in place, the harder it is to change and adapt to these new behaviors.
Well, so you're saying that the US is lagging behind in this innovation
Significantly. Now, the only saving grace in the US is Silicon Valley. They have a large innovation force that comes through Silicon Valley. And they find workarounds to the constraints in the US system. But large sources of funding with private equity and venture capital, is really what enables Silicon Valley to keep innovating. But we're now getting to this point where large Silicon Valley players are being held back because of the regulatory environment. A good example is Apple recently launched a physical credit card because of the constraints placed upon them by the existing industry. If Apple wants to compete in China, There's no way they're going to do it with plastic. They have to compete purely on a mobile payments basis. And so that's a good example of where even a large tech company can't innovate in the US at the same rate as some of those in other markets.
I mean, this is interesting because Latin American countries generally tend to take their cues from the American system. Mhm. And now you're saying that we should look eastward.
Should look at China. When it comes to banking, the most advanced economy in the world right now is China. Second, I would look at London and the EU.
Even now with Brexit looming?
Yeah, but London City what they've done is very progressive. I think economically, as you know, you and I would agree on this, I'm sure. Economically, Brexit's going to be a disaster for the UK.
No question
It's going to be an unmitigated disaster. It'll probably take them 20 years to recover, I think. And it's increasingly evident that they're going to have a hard Brexit with no real solutions. So it's going to be a real mess. So an interesting social experiment in that respect. But yeah, definitely look at the EU, look at Singapore, look at Hong Kong. These are markets who are all good markets to show how innovation has worked in their markets. US is probably just on payments alone 7 to 10 years behind China right now.
To wrap it up, give me, if you will, 1, 2, 3 that mainstream bankers in a Latin American country like Mexico should be doing.
Okay. First and foremost, look at the leadership. Is your CEO a technologist? Is your board and your executive committee, are they technologists? Number 2, start thinking about how to break down the silos of data that's going to drive the future of your business. So you can't have successful AI deployment without really investing in data. Third, think about designing the bank of the future from your existing stack around the experiences of banking in the future, not taking the products you produced in the branch and putting them on digital. Start thinking about first principles design philosophy. Take the top 5 problems that customers face in each segment every day and think about ways to solve those problems with technology in a pure experience way, not saying, this is the product we have in the branch, how do we get it on a mobile phone? And so that design process will produce some really radical thinking that will also force the organization to change. It'll force organizational structural change. It'll force technology shifts in the organization. It'll force a leadership change. So once you start trying to build the bank of the future, either you get to a point where the bank says, no, you can't do this, or the bank says, if we're going to do this, we have to change.
Last but not least, given all these challenges, how important is continuous education, financial education, technological financial education for the people working in this industry?
It's absolutely essential. One example I use in the book, Siam Commercial Bank in Thailand, and they recognized that they had the wrong skills in the organization. And so they actually did a memo, and the CEO spoke to all the employees, and he said, listen, we are going to start multiple training programs in different areas. You'll be able to select these paths you want to go down. If you're interested in artificial intelligence, if you're interested in behavior, if you're interested in building technology experiences, if you're interested in new identity systems, tell us and we will have training and we'll build mechanisms to retrain you for jobs in the future. If you don't want to change, if you can't think about making this shift in your career at this age or in your part of your career, we will help you exit the bank as painlessly as possible. But you have no future in the bank. It was a very clear cut. And I think you're going to see that happen more and more within banks. In the US, they're more brutal about it. They're just, tens of thousands of employees they're making redundant and hiring new people. So in the US, they're not being as community-minded or social-minded as I've seen, for example, in Thailand and China. And so that retraining and that education is definitely a solution. But you've also got to convince people that the future is inevitable and that they either should be a part of that future and help them be a part of that future, or, well, that's the thing. It's like, if you take an example like a teller or a credit risk officer that right now today manually checks documents. I understand that this person losing their job is going to be a big problem for them. But the fact is, if your bank relies on checking physical documents, the entire bank will be out of business in 10 years. So you can't just accommodate that old behavior just in order to keep these jobs. You know what? If you look throughout history, this is one of the great lessons that history teaches us. Employment is constantly changing as a result of technology shift. Look at America. In 1850, 70% of the US labor force was employed in farming, making food on farms. Today, it's 1.6% of the US labor force. Now, I'm sure at the time when tractors were starting to come in and displace people from the farming industry, people were saying, this is terrible. What are you going to do about all these people who lost their jobs? Now, many of them went into like the combustion engines, Model T Ford production line, and things like this. The economy changed. Some economists say that the Model T Ford production line was the creator of the middle class momentum behind the post-war, Second World War growth of the American economy. And so that change in labor force dynamics was responsible for incredible wealth creation. But people's jobs change constantly. Today we have social media marketing managers and AI programs. We have all these new jobs we've created.
Didn't exist
Right.
20 years ago.
Exactly.
10 years ago.
So the world of employment constantly changes. And if you've got a job that's under threat because of technology, you shouldn't expect that your employer is going to protect you from that by letting you still do the same things you've done the last 30 years. Your employer, the company, has to change to remain relevant. And so the biggest skill that I think individuals should learn to be relevant in the future is the ability to adapt and learn. Number one, continuous learning, continuous adaptation. Our kids, our children, they're not going to have a career for life. They're not going to go to university and come out and be in that career for life. They may be in the same industry or sector, but their career is going to change constantly throughout their life. And so that adaptability is absolutely core to being successful in the future.
How do events like this digital and open banking training week by RiskMathics help people in the industry?
So before you can get people to come to that mindset that either they have to change the bank that they're working for, or personally in their career, they have to change and adapt, they have to be aware of the extent of these changes and the rate of these changes. So that's why I come to events like this. Is part of my role in this future is helping people see the future that we're going to, helping them believe that this is the way things are going, so that they will get the incentive to change. It's sort of carrot and stick, It's like, if you keep doing the same thing you're doing, your business is going out of business and you're going to lose your livelihood. But if you embrace these new technologies, then you can be more successful than ever.
Mr. King, undoubtedly, you leave us with a lot of ideas to ponder and a lot of thought-provoking insights. I hope we can have the opportunity to discuss these ideas again in a few years' time.
I would love it, and once again I want to thank RiskMathics for inviting me back to Mexico City. It's been a great event. Everyone's been very hospitable, and the food has been amazing.
Oh, thank you very much.